Okay. Right. Okay. So students, yesterday we talked about fixed exchange rate, right? And there can be some confusion about that, but obviously you will tell me if everything was clear or there was some confusion which you want me to go over again, right? So if there is this case, do let me know. Walaikum assalam, Abdul, how are you? Okay, now think about this. So far we have talked about two types of exchange rate. We haven't fully complete. In fact, we did complete the fixed exchange rate, but again, if there's any confusion, I don't mind going over that again. So types of exchange rate, students, think about this. By now you should be clear that exchange rate, what are exchange rates, which is very simply speaking value of one currency in terms of another. That's the first thing. Then the second thing that you need to know is that how are exchange rates determined. So we said that just like any other product commodity, like that we buy from market, that can be clothes, shoes, laptops, cars, whatever, right? Similarly, currency is also a product. It's also a commodity, right? For which there is certain demand for the currency, and then there's certain supply for the currency. Where the supply and demand for the currency intersect, that is where the exchange rate, that is what the exchange rate of the currency would be, right? And obviously, you are comparing its value with some other currency, right? So on the y-axis, that's why you don't have the price. In fact, you have dollar per rupee. So what you're looking at is that how many dollars can each rupee buy, and whichever of the two is the second currency on the y-axis. In this case, it's rupees. So that is the one that you will have on the x-axis. So on this graph, you'll make the demand for rupees, which is downward sloping, and you'll make the supply for rupees, which is upward sloping, right? This is upward sloping, right? And that is what will determine your exchange rate. So let's say $0.01 per rupee, right? And then if any of the factors that affect demand and supply of this currency changes, then there will be a new equilibrium reached, right? Which we have already talked about and discussed, right? So very simply speaking, if let's say Pakistan start exporting more to USA, if Pakistan is now exporting more to USA, then demand for Pakistani rupees will increase, which means that there will be a rightward shift in demand for rupees, and that will result in higher exchange rate, right? Which means that our exchange rate appreciates against dollars, right? Or to put it another way, dollar depreciates against Pakistani rupees. This is how you sum it up, right? This is how you explain this. Easy, simple. Okay, now this is free floating exchange rate. Any exchange rate in which the government doesn't interfere, in which the government doesn't intervene to set a certain price, that is free floating exchange rate. On the other hand, if the government is actively trying to maintain a certain value, now we'll do a quick recap of the fixed exchange rate that we discussed yesterday, because as I said, there can be some confusion around that. So we'll quickly recap that and then move on to the managed exchange rate, right? But let's first go over fixed exchange rate. Now, fixed exchange rate is complete opposite of free floating, right? In fixed exchange rate, government tries to maintain a certain value, right? So government will not be fine. Government is not fine with any value of the exchange rate. They want to maintain a particular value, right? So let's take the same example. So dollar per rupee, right? And let's say we're looking at it from Pakistan's perspective, right? Also known as pegged exchange rate. Yes, that's correct, Abdul. So fixed exchange rate or pegged exchange rate, right, is basically the same thing, because you're pegging your exchange rate, which means you're fixing it at a certain value, right? So that is pegged exchange rate. Okay, now since rupees is the second currency on the y-axis, so you will have quantity of rupees on the x-axis. So you will have quantity of rupees on the x-axis. Is this simple? Okay. Now what do we need to add to this? We need to add the downward sloping demand for rupees and upward sloping supply for rupees, right? So this is how it, let's say, looks like. Wherever the two are equal, that will be your equilibrium position. That will show you the initial exchange rate. This shows you the initial exchange rate, right? So let's take the value of $0.01 per rupee. $0.01 per rupee, which means that at the moment, $1 buys 100 rupees, right? Again, this is 0.01. If this is 0.01 for each rupee, then technically we can also write this down as $1 buying 100 rupees, because if you divide 1 over 100, if you divide 1 by 100, you get 0.01. Easy, simple. Okay, now let's say this is the value that the government wants to maintain. So government wants to maintain exact same value, right? This much value, right? Where 100 rupees buy you $1, right? Easy. Okay. Now, if the exchange rate changes, from this initial level, now this is very important. I want you to understand this, right? at any point in time, there are hundreds and thousands of transactions taking place that involve exchange rate. Let me repeat this, right? Whatever two currencies you are assuming, between those two countries, there will be hundreds and thousands of transactions taking place on daily basis, which means that the currency would be bought and sold, right? And obviously that is why the exchange rates fluctuate, right? So let's say, and this is the value that the government wants to maintain. Recently, what happened, I'm using the same example that I gave you yesterday. So let's say what happened, that Pakistan imported some goods from USA, right? So when you import something, we know this already. So when a country imports from another country, the supply of your country's currency will increase, right? Why? Think about this. Because you are giving your currency to buy that foreign currency. Are you getting me? So if we are buying something from USA, increasing the supply of PKR, exactly correct, right? So if we are buying anything from the USA, then we are giving so how would that work? Let's look at this one more time, right? So the bank, right? So whatever intermediaries involved, whether that be a bank or, foreign exchange or so on, right? So which means Pakistan in this case, is giving its currency to USA. So our currency gets converted into dollars. Our currency gets converted into dollars. So PKR gets converted into dollars. Yes or no? Right? So the currency that you give to bank, what did I say? That it is that currency's supply which increases, and the currency that you demand from a bank, it's that currency's demand that will increase. This is making sense over here, right? So which currency is being provided to the bank? Rupees, and that's why its supply is increasing. And which currency is which currency is being bought from the bank? Dollars, and that's why dollars demand is increasing. Is everyone absolutely clear on this? This is making sense. Is there any confusion around this, right? So every time you import from another country, your currency supply will increase. Easy, simple, okay. But what's the problem with this? When the supply, right? Okay, just a second, look into it afterwards, right? Just a second. People who can see Zoom may not have access. Right, just give me a minute. Just give me a minute. Okay, I'll look into it afterwards. Okay, now think about this, students. So now when your country's supply has increased, when your country's currency supply has increased, the new exchange rate is weaker than the one that you wanted to maintain. So this level is less than what you want to maintain, right? So now let's say each rupee is buying $0.05, right? So this is obviously lower than what you wanted to maintain. Is everyone clear on this, right? So now your exchange rate has become weaker than what you wanted it to be, right? So what will the government do if this is a fixed exchange rate, right? Now let me ask you all. So if this is a fixed exchange rate that the country is maintaining, and it wants to maintain this particular level, which means that you would want to bring your exchange rate back to the level that you want to maintain, what will your central bank do? What will this country's, which is Pakistan in this case, the central bank do? Who can tell me? And how would that operate? How would that operate? Do you remember? Right? Is everyone clear on this so far, what we have done over here? Right? Sell dollars. Excellent, right? So your country will sell dollars to buy rupees, start supplying dollars to demand rupees. Excellent, excellent. That's correct. Very good, Rail. Very good, Abdul Rahim, right? So your country's central bank will sell dollars and demand rupees in exchange, so that what? So that your country's demand, so that your country's currency's demand artificially increases, which means the currency's demand curve will shift to the right, like this, upwards. And now this is where you have brought your exchange rate back. So you have brought your exchange rate level back to the original level that you wanted to maintain, right? So because this is due to new supply demand for currency and S2, which is the new supply for your currency, right? And they both are intersecting at this point, which is exactly the level that you wanted to maintain. How many of you are clear on this? How many of you are clear on this? And what did I say yesterday? That if you get a question on the exam about fixed exchange rate and the question doesn't specify, if the question doesn't specify that you have to explain it with the help of a diagram, then it's totally up to you whether you want to make the diagram or not. But if the question says yes, if the question says explain with the help of a diagram, then it is kind of, then you have to do it. There is no other way around that, right? So, and this is known as what? This is known as devaluation or revaluation. This thing, the example that we've just done, is this known as devaluation or revaluation? This is known as devaluation, right? Because you artificially made your currency stronger. From this level where it reached, you brought your level back up to the one that you wanted to maintain. So this is known as revaluation. How many of you are clear on this? Right? And simply speaking, the mechanism that's involved in the revaluation, let me also write that down for you. So revaluation is selling foreign currency to buy local currency. Selling foreign currency to buy local currency, that is what revaluation is. Right? Let me write that down for you. Okay, I will look at this. Where is the cursor? Okay, now revaluation is, and why are we using the word revaluation? Because you can't use the word appreciation, because the difference between appreciation and revaluation is that appreciation happens naturally, whereas revaluation is done by the government artificially, right? Sell dollars to buy local currency. It might not always be dollars, but you get the point that you are selling the foreign currency to buy local currency, right? That is what you do in revaluation. And opposite to this, in devaluation, you sell your local currency to buy foreign currency because you want to make your currency weaker, right? Sell local currency to buy foreign currency. Sell local currency to buy foreign currency. Does it make sense? Is this simple? Okay. Are there any questions so far? If the demand increases back, will it be devaluation? If the demand increases back, will it be devaluation? Okay, think about this. So let's make it even more simpler. Abdurrahim, let's make it more simple. And if anyone is still confused, let me explain that again. So if you are trying to bring your value back up again, that is what? That is revaluation. And if you are trying to bring your value from the current level, you're trying to decrease your value of the exchange rate, right? Then that is devaluation. So Abdurrahim, you have to see what is the objective that the government wants to meet. What is the objective that the government wants to meet, right? So if they want to increase it from the current level, then this means that they are interested in revaluation. And if they want to decrease it from the current level, this means that they are trying to devalue the currency. Right? Okay. Now we will talk about all the questions, students. So I know a lot of you have questions like, why would any country devalue its currency, right? And I gave you a very brief explanation for that, that China has very weak currency relative to, its trading performance. Compared to the trading performance of China, its currency is not very strong. And what's the reason? As per USA, right? I don't know. I don't do research on these things, right? As per USA, China artificially keeps its currency weaker, which means that USA is always accusing China of devaluation. Are you getting me what I'm trying to say over here, right? And where are all these, right, exports will increase. And where are all these cases heard? So the World Trade Organization, I'm sure you would have heard about it, WTO. So World Trade Organization is the ultimate organization, institute, whatever you want to call it, that is responsible to oversee all the international trade taking place between countries, right? So if, let's say, there is any dispute between two countries, right, and they want to resolve that trade dispute, right? So if there's any trade dispute that needs to be resolved, the case will be filed in World Trade Organization, and then it is the World Trade Organization, which is part of UN, that decides which country is, which country is on, right, which country is justified in the case and which is not, right? So this is how it goes. Is everyone clear on this, right? Okay, now let's quickly look at the example, students. Let's quickly look at the example of devaluation before we move on, because I don't want you to be confused with this, right? So please pay attention. Okay, so what do we need to show, right? This time, like, how about we change some currencies, right? Too much of dollars and rupees, right? So let's say pounds per euro, right? So we're looking at pounds per euro, right? And you have quantity of euros on the x-axis. You have quantity of euros on the x-axis. Okay, is this good? Does it make sense? Okay. Now, what currency demand and supply will be on the graph? Which of the two currencies demand and supply will be on the graph? Which two currencies will be? Which of the two currencies demand and supply will be on the graph? Come on, that shouldn't be difficult. Will I add the demand and supply of pounds, or will I add the demand and supply of euros? It will be the euros. Exactly. Excellent. Because it's quantity of euros, right? So it has to be demand and supply for euros, not pounds, right? Okay. So basically we're looking at from euros perspective. If I would have written pounds over here, then I would have made the demand and supply for pounds. And then in that case, we would have looked at from pounds perspective. But in this case, we're looking from euros perspective. Okay. Now let's say initial exchange rate between the two countries was, let's say this much. Let's make it simple. So 1 pound buys 1 euro, right? So it was the initial exchange rate. And this is exactly with your topic PPC and what about PPF. I mean, that's the very first topic, production possibility frontier, right? It's the same. It's the same thing. Astam, if this is your question, but I do get what you're saying, that you are facing problem with the production possibility frontier and production possibility curve, right? So we can do a recap, but for that we will need to wait till we complete our syllabus, right? So we'll definitely do a recap, but it's not that difficult. So it would hardly take us 15, 20, 30 minutes to, I'll do a quick recap. You should be good with that. Okay. Now students, is everyone clear on this, right? So let's say this is the original initial exchange rate value, and this is exactly the value that the European Central Bank wants to maintain. In Europe, I'm sure exchange rates are not fixed, but we are doing it for the sake of example. Are you getting me or not, right? So this is the value that the European Central Bank wants to maintain, that each euro should buy them 1 pound. Each euro, 1 euro should buy them 1 pound. Easy? Are we good on this? Can we move on? Okay, now what happens, let's say there are a couple of things taking place, and let's say this is an example of devaluation, right? This is an example of devaluation, right? For some reason, let's say there is some major event taking place in Europe. Some very interesting festival is taking place in Europe, and a lot of Britishers are coming to attend that event. Are you getting me? What the example was, that there is some event taking place, some very massive mega event taking place in one of the countries in Europe, and Britishers are coming to attend that event in Europe. Let's say that might be France, or that might be Germany, because that doesn't make any difference, because all these countries use the same currencies. You would know, right? European Union use euros, right? So for that, if that happens, right, what will happen to the demand for euros? The demand for euros will increase. Now, let's say each euro buys you 2 pounds. Each euro buys you 2 pounds. Exactly. Demand would increase. Very good. Let's say if each euro is buying you 2 pounds instead of the initial value of 1 euro equals 1 pound. Now, euros has become stronger against pounds. Euro has become stronger against pound. And that is what the European Central Bank doesn't like. Why does European Central Bank doesn't like? Because they want to maintain this value. They're not interested in higher value. They're only interested in maintaining this value, which is this one, right? Now, what will the European Central Bank do? What will they do? Okay, Arbab, let's look at this one more time. Students, let's look at this one more time, quickly, right? Stay with me. Wherever you lose, just let me know. Okay, is everything clear so far up to this part? Right? Arbab, up to this part, you would be clear, right? Right. Just a second, Abdul Rahim, I'm coming to it. Okay, so think about this. This was the original exchange rate, and this is exactly the value that the European Central Bank wants to maintain. So European Central Bank wants to maintain this particular value, which means that each euro should buy them always £1. Each euro should always buy them £1. Are you getting me? Right? Now, this being said, what happens? Let's say I'm making up an example because we are doing an example of devaluation. So let's say there is some very interesting event going on in Germany, or there's very interesting event going on in France or Spain or whatever, right? Or one of the European countries. And Britishers are traveling from their country to go to Europe, right? Britishers are traveling from England to Europe to attend that event. Is this making sense? Is everyone clear on this, right? So what will happen in the background? We have already discussed this a couple of times, that when tourists are coming to your country, the demand for your currency increase. So when tourists are coming to your country, whatever country that might be, right, the demand for your currency will increase, which means that your demand curve will shift to the right. Your demand curve, above, is it making sense, right? Your currency's demand curve will shift to the right because your currency's demand is increasing. So it will be a rightward shift, upward shift in the currency's demand, right? And the new exchange rate after this change will be £2 for every $1. £2 for every $1. Sorry, £2 for every €1, right? Easy. Is this making sense? Right? Is it simple? But why is this a problem? This is a problem because European Central Bank wants to maintain this value. They don't want a high value. They want this value. As simple, right? Now, what will the European Central Bank do to bring the value back down to that, right? Is everyone clear on the question that I asked? So what will, right? What will the European Central Bank do to bring the value back down over here? So they will sell euros. So when you want to make your currency weaker, you sell your own currency and buy the other currency that you buy any foreign currency, right? So in this case, you will sell your euros to buy pounds, right? Easy, what Ruhail said, right? Is everyone clear on this or not? So when you sell euros, have a look at this. Students, when you sell euros, and this is the graph for euros, right? So never ever please forget or lose track of which currency you are making the graph for, right? A lot of students get confused. Oh, because obviously you see both the currencies written on the y-axis, but always think about which currency we are looking at, and that will be, you will get to find that out by looking at the x-axis, right? So if this is euros, then we have to show the effect of only euros, because higher demand for pounds will be shown on the graph for pound graph, right? Not on this graph. How many of you are clear on this, right? So when that happens, when you start selling euros, what happens? The supply curve for euros will shift. Supply curve for euros will shift to the right, and you can see for yourself that the new supply of euros is intersecting with the demand curve at this point, right? Which means it has come back to the original level that you wanted to maintain. It has come back to the original level that you wanted to maintain. Are you guys getting me or not? Is this making sense? Is it making sense, students? Yes, no? Any comments? Great, very good. Arbab, is this clear? Okay, so students, this was an example of devaluation, right? So in devaluation, you sell the local currency, buy foreign currency, and in revaluation, you sell foreign currency and buy local currency. This is how it works. Very good. Excellent, right? Now we'll move forward from here, and now we are about to discuss the very last type of exchange rate, and then tomorrow we'll perhaps talk about the most interesting thing, where we talk about the pros and cons, right? So we'll talk about the pros and cons of whether fixed exchange rates are more beneficial for an economy, or whether free floating exchange rates are more beneficial for an economy. So that we'll talk about in tomorrow's class. But we are left with one more type of exchange rate, which is managed exchange rate, right? Now what is managed exchange rate? Right, floating we have already done floating. So the first one that we did, right? So what is floating? We are not doing it separately for floating, because floating automatically means anything, exchange rate which is affected by market forces, right? Where there's no government involvement. That is floating exchange rate, right? So we have kind of already done that. So this was the one that we did. This recent discussion that we had is about fixed exchange rate, and now we are moving towards the third and the final category, which is managed exchange rate. Now, managed exchange rate, as the word suggests, has elements of both fixed and floating exchange rate. Let me repeat that. So managed exchange rate has elements of both fixed and free floating exchange rate. Neither they are completely fixed nor they are completely free, right? So they are managed between certain limits, higher and lower limits. Right, we can do that. Related to exchange rate, Abdul, definitely we can do that. Right? Okay, is it making sense? Okay. Now, managed exchange rate, the way it works is that you set upper and lower limits. You set upper and lower limits. Now, have a look at this. So let's say you have pounds per dollar on the y-axis, and you have quantity of dollars on the x-axis. Easy. Is this making sense, students? Right? Now, downward sloping will be the demand for dollars. Upward sloping will be the supply of dollars, right? Wherever the two intersect, that will be your, exchange rate, right? Okay. Now let's say the value of your exchange rate is, I don't know, let's say 0.5, because pounds is definitely stronger than dollars. So let's write it down like this. So 0.5 pounds to each dollar, 0.5 pounds to each dollar. Each dollar buys half a pound. Okay. Is it clear on this? Now, what US would do if US is maintaining managed exchange rate? It doesn't, right? As per at least what they claim, and I have reasons to believe they have free floating exchange rate, because it's a market economy. You guys know what market economy is, right? Market economy is where all the decisions, all the prices are set through market force of demand and supply. There's no government involvement, no government interference, right? So given USA is free market economy, it will have free floating exchange rate, right? But let's assume that they are maintaining managed exchange rate for our example, right? So what the country will do is that it will set an upper and lower limit, right? So they'll set an upper and lower limit, right? They will set an upper and lower limit, right? Now what this shows is, this basically shows that they will not let the exchange rate go stronger than this. So they will not let, and I'll show you in a bit, right? They'll not let the exchange rate value to go stronger than this. And also they will not let the exchange rate value go below this, right? Now let's look at the values, right? So just a second, let me shift this a little bit to the right, right? So it was pound per dollar, right? Okay, now moving forward, let's say they want the highest limit to be 1 pound equals $1, and the lowest value to be 0.2 pounds per dollar. Are you getting me? Right? So this is what the upper and lower limit shows, that they don't want their exchange rate to be stronger than 1:1, and they don't want their exchange rate to be weaker than $1 equals 20 cents, pound cents, whatever, I don't know, what is that called, penny, whatever, right? Does it make sense? Students, are you getting me? So this is what the managed exchange rate is. This is what the managed exchange rate is, right? If in case, now let me give you an example, and then I'll see if you really understood the game. Okay, now if let's say for some reason the demand for dollars is increasing, if for some reason, let's say the demand for dollars has increased by this much, now what happened? The value of the exchange rate has moved above the upper limit. Are you getting me? So let's even get rid of this, right? So if we are doing managed exchange rate, if let's say for some reason the demand of dollars increases so much so that it goes above the limit that the government has set, right? So if the demand for dollars increased from D1 to D2 by this much, right? Then we know that the exchange rate value will go above the upper limit set by the government. Now, in that case, what will the government do? Just tell me, what will the government do if it's a managed exchange rate and they don't want the value to be higher than the upper limit? They'll sell dollars and buy pounds. Excellent. How many of you got this? What Rohel just said. How many of you are absolutely clear? Because you're using the same mechanism which you were using in the case of you're using the same mechanism that you were using in the case of fixed exchange rate, right? So you're using the same mechanism that you were using in the case of fixed exchange rate, right? So let's look at this one more time. If anyone is still confused, let's look at this one more time, right? So students, think about this. If these are the upper and lower limits, right? So these are the upper and lower limits that the government has set, right? Now, if for some reason, right, the demand for dollars has increased so much so that it has gone above the upper limit. If the demand for dollar increases, and what could be the reason for that? Let's say USA is exporting more military equipment to UK, right? So USA that specializes in military equipment and so on, they are exporting their military equipment to UK. And when that happens, the demand for dollar increases, which means that the demand curve for dollar shifts to the right from D1 to D2. And with that happening, will they bring it back to the upper limit? Right, that depends. Well, that's a very good question. Why will they set a limit? Abdul, let me complete off with this and I'll answer your question, right? Now, if it has gone above the highest limit, right? To quickly answer your question, Raheel, so I mean, that totally depends. They can just bring it a little down. They will not want to bring it to the lowest level or the lower limit that they have set. Why? Because then that means that you need to sell a lot of your dollars, which you like, that will make it very weak, right? But that depends on the central bank's policies, how much weak is good and how much strong is good, right? It depends on that technically, right? So students, I think following me over here. So if USA starts exporting more to more to UK, which means that the demand for dollars will increase, the demand curve shifts to the right, upwards, and the exchange rate value has gone above the upper limit that you have set, right? The exchange rate value has gone up higher than the upper limit that you have set. Then the government will bring it back. The US government will bring it back. How so? So they will, right? They will increase the supply, exactly what you were doing in the previous case. They will increase the supply, right, of dollars. They will sell dollars and buy rupees. And now you can see that the new supply and new demand curve are intersecting at this level, which is within the limits, right? How many of you clear on this? Easy? Is it making sense? Right? Is this making sense? There was another question that I did not answer. Why they will set a limit. Okay, Abdul Rahim, to answer your question, think about this. Abdul Rahim, to answer your question, the answer is very simple. You don't want the exchange rate to fluctuate a lot. And then, right, think about this. So managed, what is the reason? Why is the exchange rate managed? So the simple explanation for that is you don't want your exchange rate to fluctuate a lot, but you also don't want it to be fixed at a certain value, because maintaining exchange rate at a certain value, which you do in fixed exchange rate, can take a lot of pressure on your foreign currency reserves, especially when you're trying to maintain a stronger value. I repeat myself. If a country is maintaining a fixed exchange rate, right, and their currency is constantly depreciating and they want to revalue it, they want to bring it back to a higher level, then that can take a lot of pressure. That can put a lot of pressure on your foreign currency reserves. So one of you was asking me yesterday that what if a country runs out of foreign currency reserves? Technically, a country can, right? So you might have heard news on in Pakistan and similarly for other countries as well, that there are news that Pakistani dollar reserves have hit the lowest level in, I don't know, 2 years, 3 years, whatever, right? And so on. So that is technically showing that we are going very much low on our foreign currency reserves. So we need to do something about that, right? Does it make sense? Students, is everyone clear on this? So you're using the same strategy that you used in the case of, fixed exchange rate. But the only difference between fixed and managed exchange rate is that over here, you have a complete range. As long as your exchange rate is fluctuating within the range, you don't care. But when it goes outside the ranges, upper and lower limit, that is when the country will interfere, right? Okay, great, perfect. Now let's quickly do the opposite example. So if, let's say, US dollars exchange rate depreciated a lot. So the supply increased so much so, sorry about that, right? So if the supply increased so much so, right? Or let's do it like this quickly, right? So upper limit, let's bring the upper limit a little upper. So a little higher. So let's say this was your lower limit, right? This was your lower limit, and this is where it's 0.3 pounds for each dollar. It's 0.3 pounds for each dollar, right? Okay, now what happens if dollar supply increases a lot? If the dollar supply increases a lot, right, like this, right? If the dollar supply increases like this, so or let's say like this, right? Just to show it's parallel, right? So if the dollar supply has increased so much that your exchange rate has gone below the lower limit that you had set for the exchange rate, then what would you do? You would do the complete opposite. You'll do the complete opposite of what we have just discussed. You will start demanding dollars. You'll start demanding dollars. When you start demanding dollars, which means you sell pounds and you buy dollars in exchange, right? Then your demand for dollars will increase again. Your demand for dollars will increase again like this, right? The demand for dollars will increase again, and it will shift from D1 to D2. When that happens, your exchange rate value comes back to the between the ranges that you had set, right? How many of you clear on this, right? This means Pakistan has low foreign currency reserves of dollars, right? I mean, it keeps changing, Ruhin, it keeps changing, right? So I was just giving you an example. This is not a recent news that I was sharing. I was just telling you what you hear in the news, right? But maybe to be very honest, I do not closely follow like the macroeconomic developments and so on, right? Sell pounds to buy dollars. That's correct. Abdul, that's correct. Supply pounds, right? Bilkul, right? Easy. But yeah, that can happen. Foreign currency reserves can be very low. Okay, so students, let's quickly talk about what we have done. We are left with a few minutes, right? So far, this brings us towards completion of the idea that we have talked about the three types of exchange rate. So that's all clear. That's all complete. Now, in tomorrow's class, I'll try to bring some, in fact, I will bring some past paper questions related to essay questions related to exchange rate, so that we get a better idea of what type of questions are asked and how you answer those questions. First thing. Second thing that we'll do is to talk about the pros and cons of different types of exchange rates, right? So tomorrow things will become more clear to you, what we were discussing in bits and pieces, that why is weaker exchange rate beneficial or why is stronger exchange rate beneficial, and so on and so forth, right? So we'll talk about the pros and cons of different types of exchange rate. And we'll also talk about why is fixed exchange rate better, or why is it not better, why is free floating better, and so on and so forth. So there will be a couple of different things that we'll talk about. Pros and cons of different ER, exchange rate systems, right? Is everyone clear on this? Any confusion so far? Anything that's not clear? Right, we good on this? Students, is everything clear? Okay, so let's stop here for today. And I was telling my students in the other class that I've tried to synchronize the folder, which means that the videos will be automatically uploaded on the Google Drive, and from there one of our staff members will upload it on the YouTube channel on daily basis, so the lag should be less. But recently I just saw a notification on my laptop which says that, I don't know, something would happen and your videos will get deleted. But I'll fix this problem. But if I'm able to successfully implement it, then we should be good, right? Okay, so students, I'll see you tomorrow at the same time. Take care and complete the syllabus. Right. Okay, so Abdul, the syllabus should be completed. So we are left with exchange rate, and then we are left with what? We are left with balance of payment, which is not a very, should not take us long. What else? Balance of payment, international trade, and yeah, so it will take us at least 10 more classes. Yeah, 10 more classes, right? And I'll definitely try my level best to get at least, even if we do past papers practice, that would be great on Saturday, Sunday, right? So I'll definitely try my best to schedule a class on Saturday, right? Okay, so I'll see you tomorrow. Take care and have a good night. Allah Hafiz. Bye.